Hey everyone, welcome back to Corporate Dakota, the place where we unpack the secrets hidden in plain sight within company filings. Today we're diving into Vroom Inc.'s latest report, and let's just say they've been busy amending some really important agreements. So what's the big news? Vroom, an online used car retailer, through its subsidiaries United Auto Credit Corporation and United Auto Financing Trust V, has amended and restated its warehouse credit facility. Think of this facility as Vroom's credit line for its financing operations, basically how they get the money to lend to their customers to buy cars. This amendment is pretty significant because it touches on the core of their financing engine. The most crucial change here is the maturity date. The warehouse credit facility, which was originally set up back in 2019, has been renewed, and its maturity date pushed to July 25th, 27. This is great news because it gives Vroom more time to operate and manage its financing without having to worry about this credit line expiring too soon. It's like getting an extension on your mortgage, giving you breathing room. However, it's not all just good news. The amendment also brought some changes that tighten things up. They've reduced the advance rate. What does that mean in simple terms? It means that for every dollar of eligible assets, Vroom can borrow a slightly smaller amount of money than before. Imagine if your bank, when you apply for a loan, suddenly says you can borrow less against the same collateral. This could impact how much capital Vroom has readily available for new loans. And that's not all. They've also increased the tangible net worth and minimum liquidity requirements. Tangible net worth is basically a company's assets minus its liabilities and intangibles like goodwill. Liquidity refers to how easily a company can access cash. So Vroom now needs to maintain a healthier balance sheet and have more cash on hand, which shows lenders are demanding a stronger financial position from the company to keep this credit facility active. Now, the filing does mention that the overall borrowing capacity, the total amount of money they can borrow under this facility, and other key terms haven't changed. This is important because it means Vroom isn't losing its ability to access a large pool of funds. It's just that the terms governing how and when they access it have become a bit more stringent. It's also critical to note that while the maturity date is July 2027, the funding termination date is August 28, 2026. This means that although the facility is available until July 2027, they might stop being able to draw new funds under it by August 2026. This could require them to plan their funding strategy ahead of that date. Putting this into context, Vroom operates in a highly competitive and capital-intensive market. Their business model relies heavily on efficiently managing their inventory and providing financing options to buyers. Changes to their credit facilities directly impact their operational capacity and financial flexibility. A reduced advance rate and higher liquidity requirements could mean they need to rely more on their own equity or other less favorable sources of capital if they want to expand their lending operations or even maintain their current pace. When we look at Vroom's stock performance and market position, these amendments are crucial. Lenders are essentially signaling that they want to see more stability and financial health before fully committing their capital. For Vroom, this means they need to focus on improving profitability and cash flow to meet these tighter requirements. If they can't, it could limit their growth potential or even force them to scale back operations. It's a delicate balancing act between leveraging debt for growth and maintaining a strong enough financial foundation to satisfy their lenders. The report is signed by Thomas H. Short, the Chief Executive Officer, which indicates this is a significant executive decision for the company. So what's my take on all of this? Vroom is clearly working to secure its financing for the future, which is a necessary step for any company in this industry. Extending the maturity date to 2027 provides some much needed stability. However, the tightened terms like the reduced advance rate and increased liquidity needs suggest that lenders are still cautious. They want to see Vroom demonstrate stronger financial discipline and a more robust balance sheet. The key challenge for Vroom going forward will be to meet these requirements while still growing its business. FLE, to do so could put a considerable strain on their operation much needed stability. However, the tightened terms, like the reduced advance rate and increased liquidity needs, suggest that lenders are still cautious. They want to see Vroom demonstrate stronger financial discipline and a more robust balance sheet. The key challenge for Vroom going forward will be to meet these requirements while still growing its business. Failing to do so could put a considerable strain on their operations and growth plans. It's a sign that while they're managing their Alright, that's our breakdown of Vroom's latest filing. What's your take on these numbers and what they signal for the company's future? Do you think Vroom can navigate these tighter credit conditions successfully? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps us out, and subscribe for more deep dives into corporate filings just like this. Don't forget to check out the Discord community linked in the description below to join the conversation. Thanks for watching, and we'll catch you in the next one.